Just making sure everything works. We are all good to go. I want to give a couple minutes for people to join. I hope everybody's having a great week and has gotten out to enjoy some of the sunshine we've had this week. I know I loved it. Hopefully, we have more because I don't want another rainy summer. That's what they're calling for, too. Makes me sad. Last summer was really rainy. So today we're talking about cash flow management. It probably ranks up there with budgeting in my world. They're both so important, and I don't think they're utilized enough, um, or utilized in the correct way. So I want to welcome everyone to today's live stream, all about cash flow management. I'm thrilled to have you all here with me today. Whether you're a seasoned business owner or just starting out, understanding cash flow is crucial for the success of any business. So let's dive right in. Before we do, I do want to take one moment and ask you to comment where you're from and what your cash flow management struggles are. And we'll see if we can help each other. So first off, let's demystify what cash flow management actually means. At its core, cash flow management is all about monitoring, analyzing, and optimizing the flow of cash in and out of your business. That sounds terrifying. It's about ensuring you have enough cash on hand to meet your short-term and long-term obligations while also investing in growth opportunities. So, layman's terms. We're going to use your household income to explain this. You know when you get paid or did get paid, because if you're a sole proprietor, your pay is based on what your company brings in. But when you were in your corporate career, you knew your paychecks. You knew when those paychecks were coming in every week, every 2 weeks, once a month, however you were paid. And those were the days that you would schedule your bill payments around because you knew when you were going to have money. And you also knew that right before payday, you were going to be cash poor. Not poor. Poor is a horrible word to use, but you weren't going to have a lot of cash. So you tried to plan your bills around that. Cash flow management in a business is very similar. There's some minor changes because nothing is as rigid as a payroll schedule, right? So why is this important? Well, poor cash flow management is one of the leading causes of small business failure. By proactively managing your cash flow, you can avoid cash crunches, make informed business decisions, and ultimately drive sustainable growth. So, like using your home budget as an example, you pay your bills around your payday because you know you're going to have cash crunches at the end of the pay period. If you effectively manage your cash flow, you can stretch that payroll out until your next payday so that you do not go without money through that whole period. So let's talk about forecasting, because forecasting has a ton to do with cash management. Predicting your cash flow doesn't have to be complicated. Start by looking at your historical cash flows, identify any patterns or trends, and use this data to forecast your future cash inflows and outflows. There are also plenty of tools and software available that can help you automate this process and provide more accurate forecasts. Personally, I don't know as though I would put the time or money into buying extra tools or software. If you use QuickBooks Online, if you set it up correctly, QuickBooks Online will help you with that. But Excel spreadsheet works very well too. I have Excel spreadsheets for many of my clients. I've always used an Excel spreadsheet or a Google Sheet, depending upon the company, in my corporate career. So forecasting, we'll go there. What do I mean by predicting your cash flow? So we're going to use simplistic terms. You have 5 clients. So if you're a human services agency, you have 5 states. If you are a accounting company, you have 5 clients, bookkeeping clients. If you are a store, you have 5 repetitive shoppers. Okay. With that in mind, you have 5 clients, and those 5 clients, 2 pay when they get the invoice. The other 3, one of them pays by the due date. One of them generally pays about 2 weeks late. The 5th one, you have to go hunting down your money for. That is their historical payment method, payment timing. So what that means is that to predict your cash flow for the next 2 months, because we're going small, I think you should forecast cash flow much longer than that, but we're going to go small. So when you take your Excel spreadsheet or whatever, however you're doing it, and you put in the days, so you send your invoices out on the 30th for the next month, or 30th for the prior month, however. So the first 2 people that pay when they get the invoice, you're going to see their payment within that first week of May. For the one that pays on due date, if you have a 15-day terms, then they're going to pay around the middle of the month. The other guy's going to pay right before he gets your next invoice. And then the 5th guy, I would move it into the next month, depending upon how much you have to chase that next person. So that's how you forecast cash flow. So now let's discuss how to spot cash flow issues before they escalate into bigger problems. Some common signs include difficulty paying bills on time, increasing reliance on credit to cover expenses, and declining cash reserves. If you notice any of these red flags, it's crucial that you take immediate action. This could mean you need to do better forecasting. If you're not forecasting, then maybe you need to change your billing terms. If it's not your billing terms, maybe you need to change the way you bill, start doing mid-month and end of the month billing. Another possibility is maybe you're paying some things too early instead of pushing it to the due date. There's lots of ways that you can take immediate action to help with that, but I think it's much more effective to know when those are coming. One of my prior corporate jobs back in the day, they were a human services agency, and in the summer we knew every year that cash was going to get hard because the kids that were referred from schools just to have their classes at the school for the business weren't going to be there because they're on a public school calendar, whereas the students that lived on campus were on a 12-month calendar. I almost said 24-month calendar. So they went to school even during the summer. But public school kids don't. So we knew that summer was hard when it came to cash flow. So we planned it out. We did any projects during the spring, winter, and fall. We tried to avoid the spring as much because we wanted to focus that cash on helping us through the summer. And we made sure that before the summer started, we had everything up to date. We had all the bills caught up. That gave us a little bit of leeway if we needed to push payments. Human services tend to have cash flow problems, I guess is a good way to put it. I don't know. So now that we've covered the basic, let's dive into some effective cash flow management strategies. Number one, optimizing accounts receivable. Speed up your invoicing processing and follow up on late payments to improve your cash inflows. You could use 50-day due dates rather than the standard 30. That's what I've done. You can add automatic interest charges on past due invoices because anybody that pays attention is going to know that that's going to happen and they're going to pay it in time to avoid that. Have your system set up to send out automatic reminders. So personally, I have my system set up. We send the invoice. It sends a reminder that it's coming due. Then it sends a reminder that it's late on the day after it was due. And then every 30 days, it sends out another reminder. All of those are going to help because nobody's going to be able to be like, well, I never got the invoice, because you attach the invoices to all of those. Number two, managing expenses effectively. I don't know why that was hard for me today. Regularly review and trim unnecessary expenses to free up cash for more critical business activities. What does that mean? You have an electric bill due every month. You can't do that. You do. But there's also variable costs that you can morph. In my example that I used, I talked about how we planned capital projects to happen in the spring, in the fall, in the winter, if it was inside, so that we knew in the summer we were cash poor. We knew in the beginning of fall we were making up for the summer. So we had to push things into the winter and into the beginning of the next spring. You go also to outings. So if you're a human services agency, we're going to stick with that thing. You either buy tickets in advance for your winter outings. You look at more free or inexpensive things to do in the winter months. In Berkshire County, it's easier because our winters are tough unless you're a skier, snowshoer, to do things outside. So you do arts and crafts. You do different activities that don't cost as much money. Those are all things that you can schedule accordingly. You just have to be proactive. Number three, monitoring cash flow regularly. Don't wait until the end of the month or the quarter to check your cash flow. Regularly monitoring allows you to identify issues early and take corrective action. I have, as I've talked about, an Excel spreadsheet for my company and some of my clients who I'm responsible for their cash flow. This Excel spreadsheet is just very basic. It's like a check register in theory, not in visual. So you have the date column, you have deposits, you have credit card deposits or ACH deposits, then you have the total of all of those. Then you have the withdrawals. You have a column for any checks that you've written. You have a column for any voids that you did on your checks that you wrote. You have a column for any ACHs that are going to automatically come out of your bank. You have a column for reoccurring things like FSA charges, things like that. And then there's a payroll column. This is set up for me. This is how my business is run. Then you total up all of those outflows. And then there's a column that takes yesterday's balance, adds in the deposits, minuses the expenses. Then you have a whole nother section. And in this section, this is where you do your checks and your balances to make sure that your bank account matches what your cash sheet says. In this checks and balances side, you have a spot where you write the daily bank balance on it. Then there's a column that automatically tells you what your outstanding checks are. Then you have a column where you write any checks that cleared in. So you do $12, $13, and then that reduces the outstanding checks. And then you have the register balance. The register balance in that column that added deposits and took out the withdrawals should balance. And that's what the final column does, is just make sure those two balance. So that every morning, the very first thing I do is I log in and I update the cash sheet. The reason why is because I have it set up so I know when my clients pay generally throughout the month, and I know any of the things that are going to be coming out. So I can project what my balance is going to be for just my fixed costs a year from now, if I needed to go that far. There are things that come up. There's things that we do that aren't in my normal budgeting process, but I add those in as I go along. But I can do those because I know where my cash is. You know, where is there going to be a cash crunch? Where do I need to make sure that I push things either before or after? I can't tell you how important it is to have that. I can't reinforce enough how helpful you're going to find that at the end of the day. So enough with my lecture. Now we'll get into some real world case studies. So to bring these strategies to life, let's look at a couple of real world examples. So Company A is a small manufacturing business that specializes in custom furniture. Despite having a steady stream of orders, they're struggling with cash flow issues due to extended payment terms for suppliers and late payments from clients. So their challenge is meeting payroll and supplier payments on time and increasing reliance on a line of credit to cover operating expenses. This is what their solution was. They implemented a rigorous cash flow management system to monitor and analyze cash inflows and outflows, my spreadsheet. They negotiated better payment terms with their suppliers to align with their cash collection cycle. They implemented a proactive invoicing and follow-up system to encourage timely payments from clients. Within 6 months of implementing these changes, they reduced reliance on the line of credit by 60%. They improved their cash reserves by 20%. They enhanced financial stability, allowing for strategic investments and growth opportunities. Doesn't that sound exciting? Sorry, I have a fan blowing over here because I don't think our AC is working here and I had a hair. All right, so we're going to look at cautionary tale, Company B. It's a tech startup. This tech startup experienced rapid growth in its first year of operation. However, due to poor cash flow management practices, they found themselves facing cash shortages, despite having a profitable business model. Their challenges were difficulty in managing the rapid growth without adequate cash reserves, poorly timed investments in non-essential assets during draining their cash reserves, and they neglected to monitor and forecast their cash flow regularly. So their solution: they secured a high interest loan to cover the immediate cash shortage. They delayed payments to suppliers and employees to conserve cash. They failed to implement a structured cash flow management system or seek professional advice. As a result of these missteps, because all of those are huge mistakes, they accumulated significant debt due to the high interest loans. They damaged relationships with suppliers and employees due to delayed payments. Would you work for somebody who wasn't paying you? And they missed out on growth opportunities and lost market share to competitors. So these case studies illustrate a critical role that effective cash flow management plays. Hiccup. In the financial health and success of a business. By proactively monitoring, analyzing, and optimizing cash flow, companies can avoid cash crunches, make informed business decisions, and ultimately drive sustainable growth. I lectured you today. I'm sorry. It's something that almost every job I've gone into has not been effectively monitored, except for probably my very first ever accounting job. And that's where I learned my strategies. So they ended up with issues. Um, you can't proactively prevent something from happening, something that you could predict easily without looking for it. By not monitoring your cash flow, you're not looking for it, and you're just setting yourself up for issues. So I've shared a lot of information today, and I'm sure you have some burning questions because you guys always do, right? So let's take an opportunity to remind everyone to feel free to drop your questions in the comments, whether you're watching this on replay or live. You can also message us if you're not comfortable letting other people see. I try to get people to comment on the video and interact with it so that more people can see it, so that we can help more people. So I'll do my best to answer all of them. If you need assistance in setting this up or more information on how to set it up, where to go, what to do once it's set up, reach out to us. We're here to help. So that wraps up today's live stream on cash flow management. I hope you found it insightful and valuable. Remember, effective cash flow management is a continuous process. So keep monitoring, analyzing, and optimizing your cash flow to drive business success. As always, if you know someone who could benefit from this information, either tag them below or share this video with them. Thank you for joining me today, and until